Let's continue to get you some commentary. Now we've got Mr. Prasanna as well joining us, Head Global Markets and Proprietary Trading at ICICI Bank. Let's get your outlook now, Mr. Prasanna, going forward post the budget. We saw that sharp slide today, stabilizing. How do you see things? Or what do you see the market taking a cue from here on?
So I think the government was faced with a couple of choices. I mean, either you go with a budget that pump primed the economy in a short-term basis using fiscal pump priming, or you use long-term or medium-term structural drivers. So I think, the government has taken a call that they wouldn't want to let loose the fiscal side of it beyond the 0.5% escape clause that they have used, and instead they are relying more on the structural side with a lot of focus on rural spending, a lot of focus on technology-related statement. It's also a statement of intent at the end of the day to say that we are going to focus on a lot of things which are important for the country as such. So from that perspective, while market went into the budget with a lot of, I would say, inconsistent expectations, because you had income tax cuts, you had DDT removal, you had the concomitant reduction in tax that the government will collect, but at the same time market was also expecting borrowing rates not to go up, which is fundamentally inconsistent, and hence I think the government has taken a call that they would not want to really increase the market borrowing beyond a particular level, and they want to stick within their means and hence do what is possible within what is allowed within the fiscal means. So from that perspective, I think it's been a very well balanced budget. So going forward, I would say a lot of reaction with respect to the budget has possibly happened on Saturday, and also don't forget that from an equity market perspective, the reaction was also with respect to what's happening globally with the virus scare increasing as the day goes by. So there is a growth scare which is coming in from the rest of the globe as well, and there was the US markets had fallen substantially on Friday, and the Indian markets was also reacting partly to that. So having said all this, I think the budget and going forward, the call would be that it's been a bond positive and equity neutral or a slightly negative budget from that perspective. So I think bond yields are going to be in the range of between 6.4 to 6.65 as we go ahead for the rest of the couple of months. And from a currency perspective, I think the fact that the equity markets have not taken it positively is a negative. But on the other side, you have the bond markets which have taken it positively, and the budget has a lot of reforms which is actually welcoming foreign investors on the debt side. So they kind of balance out each other, and for the next 3 months we are playing for a slight marginal depreciation in the dollar rupee, or rather the depreciation of the rupee.
Right. What will be the longer tenure impact of the budget on the bond markets, you think? And similarly on the equity markets in FY21 and the next year as well?
It is very difficult to take a very, very long-term call right now, because globally things are looking at kind of an inflection point. Around a month ago, it was looking like the global growth was recovering and we were in a sweet spot. And at the same time, though the growth was recovering, it was recovering just that much to ensure that the monetary policy also did not go, on the hawkish side from a global perspective. So that sweet spot, or what we call as a Goldilocks kind of a scenario, seems to have been dented a little bit because of the fact that the virus has now come down and the fears of the virus spreading is increasing day by day. The China's GDP growth, for example, is expected to be lower than 5% for this quarter, which was supposed to be in the region of 6% earlier. So from that perspective, there is a risk off behavior which is being shown by the market. Earlier we had penciled in a risk on behavior and a lot of flows coming into emerging market, and India also benefiting from that emerging market flows, but right now we need to watch that space very closely. And as far as the impact of the budget on the markets are concerned, I think like I said, it's more about failed expectations, and market went in with a lot of expectations which possibly was not sustainable. So that has actually played out on Saturday and a little bit today in the morning. So I think it's now back to the daily routine of tracking global markets and and tracking where global growth is growing, at the same time looking at the earnings season and how earnings for the Indian companies would improve. On the bond market side, I would say that it was a big relief that the government did not come out with extra borrowings for FY20, and even for FY21, I would say that the gross borrowing figure is not any higher than what the market was expecting. Of course, there are a lot of nitty-gritties like higher reliance on small savings rate to fund the markets, to fund the government's fiscal deficit and so on and so forth. But net, I think looks like the fear of the bond market was misplaced, and that's been taken well into consideration. Beyond the next fiscal year, I think you will have to look at how the government manages the borrowing program, and also the switches which the government have announced for the next year is considerably on the higher side. So we will probably need the fine print, or we'll need to closely figure out how these switches are being managed by the government. But on the other side, the possible introduction of the Indian government bonds in the global bond indices, because they have actually relaxed certain categories of special securities of G-Secs to be bought by non-resident investors. That is a very big positive. So these two kind of balance out each other. So we'll have to see it as we go along.
You touched upon monetary policy. So what are the expectations? Can we really expect much in this particular policy, since it's literally around the corner?
So from a monetary policy perspective, I would say that it's likely to be a status quo policy. We don't expect any change in rates in this policy. That's primarily driven by the fact that the last published inflation rate was well above the 6% range cap that the monetary policy works with, and the last reading was 7.3 thereabouts. So from that perspective, I think the Monetary Policy Committee would be looking at the inflation expectations that the Reserve Bank itself puts out, how the inflation expectations in the survey is turning out. And so from that perspective, we don't expect any kind of a cut in rates. We do expect the stance to remain accommodative, however, because we do expect inflation to fall from the current high as we go forward in the next year, with food inflation coming down. What we need to closely watch is the pressure on core inflation, because in the last couple of months, we have seen a little bit of upward pressure coming in from core inflation, though it is currently around the 4% kind of levels. Anything above, say, 4.25 or 4.3%, if it were to go, would be a cause of concern and might lead to an RBI change in stance maybe in the April policy, if it were to happen. But on the other hand, if headline inflation were to fall closer to the 6% or even below the 6% range because of the food price inflation falling and core inflation not really going up, then I think RBI stays where they are at 5.15% on the repo rate, and possibly the stance will continue to be accommodative.
Prasanna, good to have you on the show. Thanks so much for taking the time out and speaking with us today. Still dissecting budget.